The streaming wars continue to play out in 2023, and I think we're starting to see signs that there's really going to be two winners emerging in this market. Netflix is clearly a company that is head and shoulders above the competition, but in second place is Disney. The company has the second most subscribers to not only Disney Plus, but the company is buying out the rest of Hulu and controls ESPN Plus as well. So a big library of content for Disney. The challenge is for the other companies in the market, the Paramounts, the Warner Brothers Discovery with their Max service, and Comcast with Peacock. The streaming services of these companies are bleeding money, and I think we're going to start to see them either shut them down or combine them into some other service and begin to sell that content to other providers in the very near future, because the status quo is just not sustainable for all these companies. So I'm going to go through the theory behind this and then the evidence that we're seeing that this is exactly the way that it's going to play out. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I'm going to start with a concept that I talk a lot about on asymmetric investing, and that is the smiling curve. If you are not familiar with the smiling curve, this is exactly what it looks like. And it's just simply a chart where the x-axis is a company's scale in this case. So smaller companies, niche businesses are going to be on your left. Big companies with a ton of scale, in this case, hundreds of millions or billions of subscribers, on your right. And then value creation is going to be the vertical axis. So what you want to do as a business in public markets is typically move to the top right of this curve. You want to have a business that has a lot of scale, has a lot of pricing power, and then is therefore very profitable. The other option would be on the top left. I'll talk about the companies that kind of sit there, but this channel is actually an example of media that is going to be competing with the Disney Pluses of the world, but I don't need to have 100 million subscribers. I can have a few thousand subscribers and do very well. So if we place the media companies and the streaming companies specifically on this smiling curve, I think this is exactly how it plays out. Netflix is going to be in the top right. They have the most scale. Disney is next. And then at the bottom, you have the companies that are currently losing money. Max, Peacock, Paramount Plus. I put Fubo TV in there as well. And what ends up happening, and the reason that this smiling curve ends up playing out, is that it's a virtuous cycle on both sides. Netflix has the most subscribers. Therefore, it can afford to buy the best content, which means that it's adding the most value to those subscribers, and so it can charge higher prices. The same thing goes for Disney Plus. Notice that both of those companies have raised their prices really significantly over the last couple of years. Disney Plus in particular has, I think, more than doubled their price for their non-ad service since Disney Plus was just launched a few years ago. On the other side, if you are a company like Max or Peacock or Paramount Plus, you're trying to raise prices just to break even. But that is actually pushing customers away from you because you don't have the same quality content that a company like Netflix or Disney Plus has. So now you end up in a downward cycle. And this is why the smiling curve ends up playing out over and over again, is these companies with scale not only have the most subscribers, but they typically generate the most revenue per subscriber as well. At the bottom of the curve, you have fewer subscribers, less revenue per subscriber, and are lucky if you're able to make a profit at all. I'm going to show another chart that puts these numbers into context. This is the streaming subscriptions for all of these services. And all of the companies I've mentioned are not on here, but Netflix is in blue. The next three are all Disney properties. Orange is Disney Plus Core. That's the non-India segment. So I think that's really the best way to look at Disney Plus's subscriber numbers, is just look at that core segment. Purple is ESPN Plus, so 26 million subscribers there. In green is Hulu. So you add all three of those together and you almost get the same number of subscribers as you have for Netflix, but there's obviously going to be a lot of crossover there. So as they start to combine these services into one app, something that Bob Iger has said is going to happen, these numbers may change a little bit because people are not going to be subscribing to all the same thing, and there's a little bit of overlap between these subscribers as well. Warner Brothers Discovery is second on this list with 95 million subscribers, but the caveat there is this is multiple streaming services and the traditional HBO service. So they're calling that a direct-to-consumer product, but it's actually going through cable lines in most cases. So it's a little bit different business than the streaming-only businesses that we have for these other ones. And then Paramount Plus is the other one, 63 million subscribers, and they are just losing money like crazy on Paramount Plus. I have done videos on them in the past, but I think they're the one, along with Peacock, that are in a lot of trouble and really need to figure out, are they going to keep this streaming service operational? Or are they going to just choose to license their content to other companies?
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So right now, it certainly looks like strategically and financially, the two companies that are in the best position in the streaming business are Netflix and Disney. Disney is not yet profitable in its streaming business, but I think that's really on the horizon. Probably about a year from now, we'll see Disney turn the corner to profitability, especially as they start to combine these apps and have more of a unified service that they're serving to customers. But the companies that are in a ton of trouble are the companies that don't have the same scale as those two operators. As a result, I think it makes these really tough investments as well. Comcast is the one that owns Peacock, so they can afford to lose money on Peacock. But it's not like the cable business is doing particularly well, and they're even struggling against competition in things like broadband, with 5G wireline broadband and fiber bringing competition in a number of different places. So Comcast is maybe eventually going to start to look at cutting costs, and where are you going to cut? Well, I think Peacock is going to be a natural place to do that. Paramount Plus, this is really something they bet the company on. And again, with cable declining, they have a lot of content that needs to go somewhere. So they're going to have to make a choice. Are they going to continue losing money on the streaming service, or are they going to license that content to somebody like Disney or Netflix? Max will probably be the final holdout, but Warner Brothers Discovery has actually been one of the companies that has said that it is going to start licensing more and more of that content to some of these other streaming partners. So Netflix and Disney are the two natural companies. What happens to Max itself if a lot of that content is ending up on other streaming services? I think we may see a slow but steady decline in the Max service. Like I said, those subscriber numbers that they're showing and that they're reporting each quarter actually includes HBO as well. So that's going to be something that is going to continue operating as is, but maybe some of the popular programming on HBO makes its way to some of these other streaming services, because I think it makes much more sense for Warner Brothers Discovery to be a content business than it does for them to be a streaming business. So those are the three companies that I think are ultimately going to be in a lot of trouble in streaming. There's not going to be 5 streaming services that win long term, just like there's not 5 profitable social networks. There's not 5 profitable search engines. There's typically 1 or 2 companies that end up dominating these markets. And I think we're already starting to see this play out, that Netflix and Disney are going to be the 2 dominant platforms when it comes to streaming. Netflix obviously has its general entertainment and is the most popular streaming services in the world. Disney's still trying to figure their business out, but with over 100 million subscribers on Disney Plus, and you have the sports angle with ESPN, I think they could be a very powerful bundle in the future. Those are the only 2 places I would be investing any money in streaming right now. I think the rest of the companies are in a lot of trouble. But what do you think about the future of streaming? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.